What's up, everybody? Welcome to another episode of Swan Signal Live. I'm your host, Sam Callahan, Senior Analyst at Swan Bitcoin. Before we get started today, we have another great guest lined up. I would say he's a polymath. That's how I describe him. But before we get started, I want to bring up some of our sponsors. One is Marathon Digital Holdings, which is the largest and most technical logic. First, I want to bring up Marathon Digital Holdings, which is the largest and most technologically advanced publicly traded Bitcoin miner, as well as one of the most energy efficient. Marathon's primary mission is to increase the network hash rate, the computational power that helps make Bitcoin the world's most decentralized and secure monetary network. So go check out Marathon Digital Holdings by following the QR code below. The other is Cloaked Wireless, which is a privacy-focused provider where you can pay with Bitcoin. They are the best protection against SIM swap attacks. Cloaked Wireless is a wireless company created by Bitcoiners for Bitcoiners, whether it's to secure your primary phone number or just a low-cost secondary secure SIM. Everyone should protect themselves against SIM swaps by using Cloaked Wireless. I got friends that have been SIM swapped. It's important to get your security right, so go check out Cloaked. So like I said, we're talking to a polymath today. He probably he knows a little bit about everything and a lot about a lot of things. And so I've listened to a lot of his interviews. He primarily his expertise lies in Bitcoin mining, but we're going to go all over the place today in today's conversation. I want to welcome to Swan Signal Live the CSO of GRIID Infrastructure. That's Harry Sudock. What's up, Harry?
What's up, Sam? It's good to see you, brother.
Yeah, how are you? It's been a while. I was over at Bitcoin Park a few months ago for just a little random, I think, meetup. But it's a great thing you guys are building over there. You spent some time there a lot, right? You're a partner?
Yeah, I'm a partner at the park because I needed a second job like I needed the plague. But as Bitcoiners, the surface area of things to build far exceeds our grasp. And so Rod and Odell were kind enough to convince me to move to Nashville a little over 6 months ago. I was already here kind of halftime in the state of Tennessee. We've got a bunch of our mining operations are here. So I've been here probably about halftime since 2019. And Nashville's just awesome. It's a great place to live. I grew up in New York, had kind of gone through the whole COVID New York cycle and was ready to get out of Dodge. And so there was no more obvious or better place to be than in Nashville. And, what the park is starting to become is, really the model for how to do Bitcoin community in a kind of decade to multi-decade kind of way. So 2 dedicated buildings, dedicated campus to Bitcoin activity. We've got a ton of companies that are headquartered out of the space, whether it's 1031, Anchorwatch, Amboss, and a number of different Bitcoin companies are headquartered at the park, actually. And then just a community of members who are either hacking or building or cooking or something, and are looking for that sense of Bitcoin community. It's all happening there. So we're lucky enough to have been building that for. We just crossed our 2-year anniversary in earlier in June, but now we get to have the conference here. We're going to have, more Bitcoiners than we know what to do with in town. So it's a really exciting time to be working on, the Bitcoin community side in the great city of Nashville.
Yeah, you can kind of feel it when you're there. I mean, it's definitely a vibrant Bitcoin community, and what you guys built there already is impressive. I mean, some of the people, like I love Jesse from Amboss, and then you got Rob and Becca, Anchorwatch. I mean, I bet it's so fun just to like work in that community and just bounce ideas off each other and have like a more collaborative approach, even though they're like separate companies. You're still building on Bitcoin, right? And so it's got to be a pretty cool environment.
And yes, all of that. And the other piece that kind of runs as a through line, which is Bitcoin related, but it's also Bitcoin Park sort of DNA coded, is this is about open source, right? This is an open source movement. And so I remember when we were talking to Rob about moving, his family out here, moving the Anchorwatch headquarters out here, he's sitting in, just one of the co-working spots at the park. And, Steve Myers, who's the head of the Bitcoin Dev Kit Foundation, who wrote all the software that underpins Trident, that Rob's been using. He's like, oh, all the open source contributors who I've been working off of for the last year are based here too. So there's also this open source through line. Matt, obviously with OpenSats, is here. So we've got a real free and open source angle on everything that's happening. And I take the perspective, at least within Bitcoin and technology more generally, that sort of open source leads and entrepreneurship follows. And so we try to have that as well. We run, Nashville Bit Devs second Tuesday of every month. So there's the more technical focus in addition to, what I think we'll cover a lot today, which is more of sort of the economic impact of Bitcoin. But it's happening on a grassroots basis, on a free and open source basis. And it started here. So, I think that the opportunity to prioritize the open source community is a huge one. And you can do that without compromising on the entrepreneurship goals along the way.
Yeah. Well, let's back up a little bit for our listeners who might not be familiar with you and your work. Maybe just give a brief synopsis of a little bit of your work history, and then tell us a little bit about GRIID Infrastructure from there, like what you guys are building over there, how you came to be, and how you landed there. Love to hear a little bit about your backstory.
Yeah, certainly. So I graduated college with a Keynesian economics degree, and quickly realized that I had nothing to use that for. So I joined a fintech straight out. Yeah, I wrote my senior thesis on intraday credit spreads and how do you quantify risk premia associated with Fed expectations. So you could say I was well trained.
Yeah.
Perhaps in the inverse of what I ended up learning and focusing on. Yeah,
professional Fed watcher.
Seriously, I looked at all of the news coverage of the day that Fed meeting minutes were announced, and then coded expectations, and then tried to price risk premia against those expectations. I did not find statistically significant results, but my professor was very happy with the discussion. So shout out to Bates College for letting me out the door with that education.
Yeah. But you found Bitcoin.
I found Bitcoin. So I joined a fintech out of school, and similarly, it's like the things you learn not to do inform what you end up doing. We basically ingested all of the post-trade and margin files for 150 hedge funds that you probably heard of some of. And we basically made, them understand why there's enormous operational inefficiency in just the management of that fund. So you're putting on a short with Citi. The short is priced way cheaper at JP Morgan. The trader doesn't know that, but we knew that. So we were able to take all this sort of data aggregation and wring out operational efficiency for these funds. Then that extended to sort of the margin profiles, and your margin, you've got a basket of options that your margin account isn't taking into the calculation. So you're actually much less risky than they think you are. So you should be able to extend additional leverage somewhere else with no additional cost. So a bunch of these kind of ideas.
Those little things go a long way for those funds in terms of performance.
Oh my God. I mean, you're talking about like $20 to $30 million per fund in cost savings potentially.
Oh my gosh.
With no change in their behavior, right? All it is operational streamline.
Well.
So we built all the software for that. We ended up selling that company to a company called iCap. Then got spun out, then got sold again to the CME, and I sort of ended my TradFi experience at CME. And just all along the way, like learning how all this stuff works was very interesting, very exciting, really interesting to work with the technology professionals whose job it was to build the tooling to achieve these outcomes. But, there are banks that are still managing $1 billion margin portfolio, on a PDF. And the PDF is a big upgrade because it used to be like wet ink signatures on trades. So, so there's a lot of duct tape and chewing gum that holds a lot of this stuff together to the tune of billions or tens of billions of dollars. And so, that was like the next, so I'm already like Fed pilled because I realize that doesn't work. And then I'm bank pilled next because I'm realizing that, maybe there's a bigger system upgrade that might be available to us. And then, I'm just starting to hear about Bitcoin at this time is probably like 15 or 16. Then by 17, I'm like all the way in, and I'm super orange pilled, and I'm in the
Can
New
we
York.
pause just why do you think the banks are so behind technologically? Like, what is the reason behind that? I mean, is it just red tape? Like,
Well, it's just
why?
hard, right? Like
Yeah.
NVK talks about this concept of like societal inertia, where we've got 7 billion people and I don't know, 50 or 60 trillion dollars in GDP that's like all kind of hurtling along a train track. And think of that as like a 1,000,000-ton train that's just hurtling down the tracks. If you want to slow that train down or stop it, it's so hard. It's so big and so fast. And like the laws of physics, they get sort of increasingly difficult with scale. I think the banks are a similar sort of fractal microcosm, which is that they've gotten to be multi-hundred-billion-dollar businesses running many tens of trillions of dollars in products. Changing that is really hard. Number one, there's an enormous amount of career risk to anybody who suggests that we should change anything. Number two is that there's an enormous technology hurdle rate to get over to actually make that change meaningful. You've also got to convince them that it's profitable change, or profitable change on some risk adjusted basis. So I just think change is hard. If you're, look at all of like the companies that were the biggest in whatever 2000 or 2005, like the S&P 500 has significantly reconstituted across the top 25 or 50 companies just over the last 20 or 30 years. So I just think that we have a lot of evidence to say that change is hard and disruption is easy, like on a relative basis. So it's very hard for incumbents to win.
Yeah, for sure. And I think one of the ways they try to like hang on is to build regulatory moats, right? That's kind of one of the
right. Like the two and let's just dig in here, right? Like the ways that companies and technologies entrench themselves are twofold. One is maybe threefold. The first is existing network effect, right? Network effects are incredibly difficult to break, right? They're exponential functions. So if I add 1 unit of users to an existing ecosystem, every single user in that ecosystem benefits. The second, and I think you hit on it correctly, which is that there's a huge amount of regulatory capture. So a market leader will always root in favor of regulation because that pulls the ladder up behind them. So if the Custodia Bank case is a classic example, right? If you want to start a new bank, like you're looking at, I don't know, $50-100 million worth of legal expense and audit. And then that's no guarantee that you're going to get through the regulators who need to give you the charters in order to operate. So I think regulatory capture is a huge component of that. And then the last one is like, it's not quite network effect, but it's this like preferred vendor environment where, and this is why I think it's so interesting that BlackRock and Fidelity have entered the ETF game, which is that, if you're trying to sell to family office X or state pension Y, being an existing preferred vendor gives you a huge advantage within that environment. And so it's really interesting to see some of these firms that already have achieved that kind of preferred vendor status start to be able to sell a Bitcoin exposed product.
Yeah. Have you ever seen that chart of like bank permits that have been given out over the last like 20 years or something? It's like one a year or something, 2 a year. I mean, they're trying to stop technology from disrupting. They're doing their best, but then here comes Bitcoin in 2009. I love one of your tweets. You actually talk about how change is hard, but you say change is the cost of prosperity. And so Bitcoin, I would say, changes everything, but it definitely changes the financial system and the relationship between an individual and intermediaries. And so you came to Bitcoin, you said, in 15, 16, but then you went all in 17. So let's get back to that, your journey. So you're 17, you say you go all in. what does Harry do next?
What do I do next is I start to try to think about what company I want to start or what business I want to be in. We, our CEO and founder at GRIID, Trey Kelly, we joke a lot and say like the worst thing you can be is an entrepreneur looking for a business. It's like a very dangerous position. So I'd kind of taken my previous experience, thought about, should I start something in data and analysis? Is that the right place to play in Bitcoin? I'd already, the previous company, been through this sort of VC hamster wheel, raise money, write code, raise money, write code, hope that you have something at the end. I wanted to be in sort of a more, because now I'm orange pilled. I'm like a cash flow guy who believes that businesses should have like monthly P&Ls that make sense, and like return on capital concepts baked into them. So, and keep in mind, this is like 2017, and then early 2018, the only two businesses that made any sense at that point were basically like exchanges or mining. Those were the only sort of discernible Bitcoin native revenues that you could reasonably expect to generate at that time. And I definitely didn't want to join an exchange or start an exchange at that point. So, kind of serendipitously, like any good endeavor, it's just, two dudes who met on the internet. Trey and I met in the middle of 18, and he said, "Don't start something. You should join me. I'm going to, build this mining business." And I said, "Great," and joined GRIID as the first employee later that year. So, what was our idea, or what was sort of the governing thesis of what did we want to do? A, we were already Bitcoiners, and B, we had a belief that low cost electricity was one of the most singularly undervalued and misunderstood assets that we could reasonably land grab and turn into a productive asset quickly. So that then meant, great, now we have a thesis. We've got to go kind of build an MVP. So that meant traveling all over the world, looking at power contracts and becoming very fluent in counterparty risk, because you're not writing, there's not like a code repository that is your central asset. It's like a physical thing. It's a bricks and sticks business. So, went through the process of looking elsewhere, and some of those places, price looks great, terms look very scary from a counterparty risk perspective. And so we ended up back in the US, and were recruited to the Tennessee Valley to build our first facility and we bought the land and broke ground in Q2 of 2019, and then just expanded, built another site.
So when you say counterparty risk with the power purchase agreements or just power agreements, are you really thinking about like the jurisdiction that you're in, and like, so what's the instability risk there of the local government? All these things are factoring in, and you're like, oh, I'm actually, the United States is where I want to be. That's kind of.
Yeah. I mean, at the end of the day, like, there's a lot of ways to build a successful mining business. They all come with pretty different risk profiles, but at the end of the, you got to keep in mind, this was like 2018, 2019. Mining wasn't a mature business. China mining ban hadn't happened yet. The S19 was still, or I'm sorry, the S9 was still the dominant ASIC in the market. There, the level of immaturity is hard to overstate. So we looked at that and said, all right, we're going to go put, tens of millions of dollars of somebody else's money into what jurisdiction? What happens? What happens if it disappears?
Yeah.
What happens if the power contract gets renegotiated, and what are our rights? So we looked at that and said, all right, well, maybe the US is 10 or 15% more expensive, but the risk of going to zero is much closer to zero. And so the trade on things at that point were very much sort of swinging back towards US being the right place to build and scale the business. And then the other piece of it as well is that, power and electricity is a relationship game, much more so than it is sort of, most money, fastest timeline, that at the end of the day, like that power is going to likely get sold. And so they want to get to know you. They want to shake your hand. And they want to understand that you're going to be here for the long term and be a collaborative partner. I think there was still some scar tissue from like the 2017 run up where there were a lot of firms that were saying, I won't take a meeting for less than 100 megawatts. And, we took the approach, MVP, minimum viable product of we want 5 megawatts and we want to prove we can build one of these things and run it and generate, positive returns at that scale before we say, let's bite off a bigger chunk, which we then went and did. But, I think having some operational humility early on was one of the biggest wins that we had. And, thank goodness for the team that we were able to build, because Trey and I are not electrical engineers, though we play them on TV occasionally. And so, at that point, like our level of sophistication was, when we need like 5,000 outlets, right? And it turns out there's a lot of stuff that has to happen behind the outlet. And so we were able to hire an incredible electrical engineer in West Ward, and then hire Mike Hamilton, who sort of ran all things technology for us. And, during those early days, we were like living in a camper on the site, and I'm flipping breakers, and it's really a lean operation. So getting to touch everything and learn all the different roles and responsibilities set me up to be a more competent and empathetic business leader now, because those are jobs I've done. Whether it's fixing a hashboard or, getting on the phone with the utility when the internet goes out, like those are all things that I've done. And so when I ask other folks to do them now, it's a little more credible.
Yeah, I mean, it's inspiring too. I mean, you guys did scale and you built a successful business, and it was a good time to build too in the 2018, 29 bear market. I mean, perfect. And
Totally.
so I read a stat the other day that less than like 1% of businesses go public, and you guys managed to do that. So, congratulations. And what was it like to take, going from a camper and now you find yourself in a leadership role of a publicly traded company? I mean, tell us about that journey there, and maybe how Bitcoin mining has evolved within that.
Yeah, I think there's sort of there's two tracks to that. The first is that, we made the decision to take the company public in the middle of 21, not because we thought we were going to time the market and it was a great trade, but because, we believe for a couple of reasons, large scale Bitcoin mining companies belong in the public sphere. We are responsible for generating hash rate, which is how this open source monetary protocol works. And so we deserve to be scrutinized by the most competent and stringent regulators that are out there, which means the SEC. And so, we took the view that if we're going to be big and we're going to be, in the business of mining, we belong in the public markets. It also is a function of the fact that it's a highly capital intensive business as well. And if you look at the capital efficiency that public companies are able to achieve, it's far greater than private companies by and large. And so, made that decision. Then you look at kind of the different ways to go public. There's a couple of different options. If Swan and Corey wants a rundown on our decision criteria, I'm happy to talk him through that at any time. Because it is, each of them do really come with different trade-offs. We ended up going public via SPAC, which again, hindsight 2020, 2021, that was a great idea. It was going to be a much easier path. Those transactions were getting through regulatory review, in a pretty seamless way. Kind of hit two landmines during our review process, one of which was that the rules around SPACs changed significantly during that period of time. The other is that, seemingly the entire crypto sphere lit itself on fire via napalm, called, SBF and Celsius and BlockFi and cascading bankruptcies and
Yeah.
that, totally, wreaked havoc on our ability to communicate with regulators that we are not holding anyone else's money in any way, shape, or form. We're a self-mining business.
Or
There's
Bitcoin,
no
not crypto.
there's no
Yeah.
exchange risk. There's no shitcoin risk. There's no, none of that applies, but that still set our regulatory process back significantly. So it took us, I think we signed that merger agreement originally like December of 21. We ended up listing December of 23. So it was a very long 25-month process. But we're on the other side of it. We're grateful to be on the other side of it. Grateful for our partners who saw us through what certainly became a bit of a different journey than they'd initially anticipated from a timeline perspective. But all's well that ends well.
Yeah, you guys made it. I feel like you came on my radar because you were GRIID, and you guys were one of the first people talking about incorporating Bitcoin mining into the electrical grid, and how like the demand response and being flexible and all the benefits that it could bring. How much does GRIID still work in that capacity?
100%.
100%. You guys,
Yeah.
that's all it is. So you guys are you're mining Bitcoin, but then you're providing benefits to the grid.
Yeah, exactly. So we designed the business to be flexible because the power market is not one thing. We've taken sort of a portfolio approach to our mining sites. So we don't have a mega campus the same way that some others do. But rather we view it more as sort of a portfolio construction exercise. And so that means that, we've got sites that are exposed to, very, very sort of tariff governed, stable power environments that have more sort of weather outlier events. We saw that in Tennessee, both this past year and 2 years ago. 2 years ago, we had the single most disruptive winter storm in Tennessee in TVA's history. So what do? We gave back power for 30,000 households to avoid rolling blackouts, exactly like we planned years before. And that's all part of the plan, is that, when things go sideways, Bitcoin miners are we are the like the shock absorbers of the system. We'll be the first to react. And therefore, if you can react first, then you can save the stuff behind you from the worst of the impact. So that's sort of one version of flexibility and demand response and curtailment is highly regulated power pricing environment, but weather still rears its head. The other is that at our facility in New York, those power markets are floating. And so because you have a highly dynamic price environment, it lets you respond to economic signals rather than physical signals. And so, we look at it sort of more from that perspective, where we're co-located behind the dam. The dam is able to generate, revenue with the Bitcoin mining relationship behind the meter, and then monetize in front of the meter when the dynamics are, right side up for that to be the priority. So being able to take a generation asset and make it more productive makes that grid more resilient, more reliable, because that power has more of a revenue base in order to be able to meet the needs of the region, pay for upgrades, it's a run of the river dam. So you got to get these like crazy icebreaker things to make sure the water flows the right way. So these are all capital investments that are achievable because of a relationship with a Bitcoin miner. Their revenue profile is higher, their ability to reinvest profits is higher, and therefore the reliability from the dam in that region is more robust.
Yeah. And what's been your conversations? I mean, obviously you partnered with these people, so in some way or fashion, they were agreeable to Bitcoin mining, or else they wouldn't have agreed to the go into business with you. But have they been surprised at the technology itself and how much benefit it has brought them and their business and their jobs? I would love to hear that.
Yeah, I think I still get this. I talk to a lot of utilities. That's where I spend a lot of my time. But like the first question is always kind of like, is this real? Like there's disbelief that it actually mechanically works the way that we say it does from a demand response perspective. So, what do I pull up a slide that shows real-time data? Here's X megawatts, here they're on, then they're off, and they're back on. So being able to demonstrate with with actual
Because
track
it's
record.
that unique. Like there's nothing else like it. Like they're
Yes, I mean,
literally shocked that it works like that.
think about the largest customers for electricity traditionally, right? Like maybe it's a university, maybe it's a hospital, maybe it's some other kind of
Yeah.
manufacturing. If it's a car plant or an aluminum smelter, you can't turn the aluminum smelter off when there's liquid metal in the bay, right? You just can't. You'll ruin the machinery. So Bitcoin mining really is unique for two reasons. One is that we want as high a percentage of our cost of goods sold to be power as possible, because the higher that number is, the more efficiencies you're realizing across your operation. The second is that we run no mechanical failure risk for shutdowns. Whereas, if you're, imagine you're a Toyota plant, you can't just, and you get a demand response call. You've got 800 employees that are going to sit around for 8 hours and not do any productive work if the plant loses power. So you can't do that. Whereas a Bitcoin mining company is able to roll out that type of curtailment with no additional carried cost impact to the larger profile of the operation. So the ability to meet that need is both economically very viable, and it's also mechanically very viable, because we're not going to blow anything up because of curtailment. So I think there's those two components that marry together to create this really, really unique asset. I think, where there's still a lot of room to run is a lot of these, whether they're the utilities or the generators themselves, or maybe the published tariff or something, the programs available don't really know what to do with an asset like a Bitcoin miner in the system. And there is still some contractual complexity that makes, there's like a bunch of places in the US that I would never sign a power contract because it's too expensive. Not because it's too expensive for them to generate and deliver the load, but because they don't actually have a program that can price me competitively within their system, because they've never seen anything that looks like this before. And so maybe that's a piece of regulatory burden, or maybe it's just the fact that they've never had to build a tariff that takes our parameters into consideration as an industry. There's still tons of places in the US that just can't sell a Bitcoin miner power at an effective price because they haven't built a rate that works for us yet.
That's fascinating. The big, I've been asking some people on the show about this. I've saw Alex Brammer talking about this, but, I think about data centers too, from like an AI machine learning standpoint. They're going to be competitors for electricity as well. But even them, like if they shut down, they're going to get a lot of pissed off customers when, ChatGPT went down the other day and the whole Twitter was like losing their mind, like they forgot how to work without this thing or something. But like, they can't necessarily have a lot of downtime either with their data centers as well. I mean, what's your thoughts on that? I hear that it could impact some Bitcoin miners in terms of their electricity costs, but I feel like Bitcoin mining still offers enough uniqueness even to these, data centers for machine learning that really separates it from the pack. Am I wrong?
Yeah, no, you're not wrong at all operationally. I think what you're hitting on is that there's probably a procurement hurdle that's going to grow. So if I want to sign a net new power contract, I really might be competing with AI.
Okay.
But once you get behind that sort of hurdle, then from an operational perspective, the AI data center can't offer the grid nearly the type of flexibility that a Bitcoin miner can. So from a grid impact standpoint, the Bitcoin miner is still, by a pretty wide margin, the superior flexible load. It's just a question of at the whether it's the utility or the co-op or whoever is in charge of signing a power agreement, are they willing to sign both an AI data center and a Bitcoin mine? And do they feel comfortable from an overall balancing perspective that they're able to support both those loads, given the flexibility that each of those loads represents? And then I think in many cases, the answer is absolutely, right? They're in the business of selling power. We're in the business of buying it. But I think in some cases they may be saying, well, I'm kind of comfortable up to X megawatts, but beyond that, I'm not comfortable with the strain on the system. So, to me, that's sort of the local state of play, is that procurement's going to get somewhat more difficult, but not unachievable by any stretch. But over the longer term, what this should do is massively incentivize the development of additional generation. Right? We do not produce enough power at the end of the day, and we need to produce a lot more because we believe that prosperity is downstream from natural resource availability. And so, if you want to live a higher quality life, you need to be in an environment that believes in making available additional capacity to households and businesses on the electricity front, so that over time the marginal cost of that electricity should trend towards zero.
Man, that makes me really bullish. That's maybe the most bullish thing I've heard in a while. Bullish on humanity, honestly.
Of
And it
course.
seems like there's a flywheel there, where the more
Yeah.
demand for Bitcoin miners leads to more energy abundance, which leads to lower electricity costs, which
Exactly.
the Bitcoin miners feed on, right?
Exactly. Right. And then we're able to operate in a much higher velocity, higher integrity economy, which is just going to drive Bitcoin transaction fees, which then returns revenue back to the Bitcoin miners and lets them continue expanding.
It's beautiful. It's beautiful.
It's going to work. It's all going to work.
Yeah, I want to go back. Let's do like a little Bitcoin 101. So I think this is important because with the approval of the Ethereum ETFs, I think we're going to hear a lot more about, unfortunately, about like this proof of stake versus proof of work thing of why does Bitcoin need the electricity, right? And I think about one, this is one thing that proof of work has that proof of stake doesn't, is these benefits and this connection to the energy industry and what it can actually give to the real world. But why this? I think you're so good at this, but like, why proof of work, like versus proof of stake? Why can't Bitcoin function on proof of stake? Because I think that's a question that we're going to hear a lot. We're going to get that a lot from new people coming into the space. There's going to be a lot more messaging from the other cryptocurrencies around being like 99% energy efficient and all that crap. So let me get your answer for that, because I think you're going to nail it, honestly.
Well, there's a lot of ways that you can attack why proof of stake is an inferior consensus mechanism. But basically, think about what Bitcoin's designed to do, right? Bitcoin is just a database, and our database is special. So it has two features, right? You can read from the database, which is called running your own node and looking something up, or you can go to mempool.space and look it up there on somebody else's node, but that would be non-sovereign. Or you're going to write a new entry to that database, which is sending Bitcoin, right? Every time you put a transaction into the mempool, that proposed transaction is a proposed new line to the database. And when that transaction is included and confirmed, that means it's added. And what you're basically saying is, I need some reasonable assurance, let's call it an attestation, that the addition of my transaction is valid and achieves this concept of settlement. So how does the Bitcoin network do that? Is it makes sure that every miner who proposes new blocks is proposing those transactions in an in-consensus way, which means that all the other nodes whose job it is to validate that block, they're not going to, let's just say I tried to spend the Bitcoin in two different places and a miner included that transaction in a block, that block would be rejected. The other is that I can't just spoof up a bunch of blocks, because there's a huge amount of electricity required to find a block, which is the proof of work, the proof of the use of the electricity to propose these new transactions. So, I will push back on what you said earlier, which is that, they're going to claim energy efficiency. No, they're going to be able to demonstrate lack of security. We are demonstrating an enormous amount of security. Their lack of energy usage demonstrates lack of security. So, why is that? It's because every time I put a new block out into the world, there is probably 10 minutes on average of 15 gigawatts of electricity looking for that block. Now, if I were to try to recreate that amount of compute, it would take me, tens of billions of dollars and many, many, many years to try to figure out where to find the power and build the data centers and the concrete and source the servers and all this other stuff. So when I send a Bitcoin transaction, I have an enormous amount of confidence that when I achieve settlement, aka a new block adds that transaction to the network, and then new blocks are added on top of my block, that I have just this enormous amount of certainty that the settlement of the Bitcoin is in consensus and will allow for the next key signer to be able to move those UTXOs into the future. That's why Bitcoin's great. Why does proof of work suck? Is because you take an asset hypothetically, where 70% of that asset was sold in a not a security offering. And then 30% of that was mined, and then we pivot from this proof of work environment back into a proof of stake environment, where if you own a bunch of ETH, you now are a qualified proposer of transaction processing. So what Bitcoin does is it takes the self-referential component out of the network. So no matter how much Bitcoin you own, you have no ability to control the future processing of blocks. In Ethereum, for instance, the more ETH you own, the greater control you have over the processing of blocks and appending of the ledger.
So it separates those two functions. That's what Bitcoin does.
Exactly. So what Bitcoin does, it separates those two ideas so that you're in more of a like a check and balance environment. So do you want to go live under dictatorship, or do you want to go live under tripartite representative democracy? These are more analogous to the ideas of why does proof of work better assure you as a Bitcoin user that the value proposition that the network offers is upheld. So censorship resistance, fixed monetary supply, auditability, all of these different dynamics that we've come to rely upon as Bitcoiners are upheld by the proof of work system, because it becomes like the coefficient of friction that doesn't allow changes to be made to core properties of the network, such that the value proposition that you invested in, spent time on, have worked on, is going to be upheld long into the future. The other component of that is this backward compatibility idea. So in Bitcoin, we basically don't hard fork, or we operate under what I would consider a hard fork minimization regime. You just need to look at the development ethos in a place like Ethereum, where they're changing the monetary policy on a regular basis. They're changing a bunch of the different parameters of the network, whether that's a shift from proof of work to proof of stake. That's a hard fork, right? There's no backward compatibility in any of those software states. Bitcoin has backward compatibility, I think, to 2013, 2011. And so you have this so let's just say I don't agree with a soft fork, for instance. I just don't update the software.
Yeah.
Right. If there's something I don't agree with, I just don't update, and I'll remain in consensus. Whereas in these other environments, proof of stake basically creates this power dynamic where if you don't go along with the new change, your asset is obsoleted away.
Yeah.
Right. If you hold ETH pre-hard fork and don't hold, ETH post-hard fork, you don't have an ETH. So you're in this hostage environment to the development cycle. And that's all downstream from this design choice to use proof of stake as a consensus mechanism.
Yep, exactly. I mean, I agree completely. And there's nothing wrong if Ethereum wants to be this protocol that changes a lot. I mean, that's what they've done. They basically, it's totally different. And it just doesn't have the security or settlement assurances that Bitcoin has, because Bitcoin prioritized that. And that's what proof of work offers. Proof of stake, I would say, it increases the likelihood that there will be more and more changes in the future. And there's been 19 hard forks since the DAO hack in 2016 in Ethereum. I just looked that up. And with each change, the problem is that it just seems to be getting more complex over time. And there's a saying in protocol development that complexity is the enemy of security, because it just increases the attack surface, right? And so Yeah, that's what I think people just need to understand those differences and understand that even Ethereum proponents will say that it's becoming more complex over time. And actually, the move to proof of stake was supposed to be the last upgrade, but now they've already upgraded it again, and they're already planning another one. Each one has a change to its monetary policy. So with Bitcoin, because the major upgrades have been soft forks. Like you said, they're backward compatible. So you could put your Bitcoin in a hardware wallet, bury it in the ground or whatever you want to do, like put it in a safe and go to sleep, go in a coma for 10 years. And you can pretty much trust that nothing's major is going to change. There's still going to be 21 million. Um, your Bitcoin is still going to be able to, there's not going to be a hard fork in that process. With Ethereum, you just can't. History has shown you can't do that. I mean, you can't even do that for a year. There's usually a hard fork every 6 to 12 months.
And look, that's fine if that's the development path that they're interested in and supportive of. It just isn't where I want to secure my savings.
Right. Exactly. And I think that's the
and
yeah.
and,
Exactly.
and it means that I'm going to be incredibly intolerant of a false equivalency driven off of energy use as a critique of Bitcoin.
Right, exactly, because the energy use is so crucial to those settlement assurances and the
It's not
ability for
wasted.
it to
It's
function.
spent.
It's spent and it's worth every watt, to have this store of value, right? That's
And
never been had
and
before with a fixed supply.
and the Bitcoin network en masse is a positive return business to the miners. So the miners are spending X amount on power and they're receiving Y amount in Bitcoin. And that's a sufficient return to justify the continued operation of their businesses.
Right. They're paying for it, like anybody else. They're making use of the energy. So,
No,
the whole
nobody
argument is
says you're
flawed.
wasting electricity on Netflix. You're paying for it. You know,
Yeah. Oh man.
you're not
Yeah.
wasting
So
time.
yeah, I mean, I just wanted to get that out there because I just feel like that's coming. The last thing, I just want to mention is just, the halving happened, and there's a ton of speculation about how it would impact the mining industry, and the price has gone sideways. I think people are just impatient, personally, but price has been chopping around. People are like, "Oh, this is miners selling," and yada yada yada. First off, I wonder how true do you think that is? Like, this is like miners selling, and then how has the mining industry kind of handled this halving? Would you say? Those are kind of two-part question there.
Um, I don't know if it's miners selling or not, but I don't think it matters because miners generate 900 and fee plus fee Bitcoin each day. Way more than that gets traded on every single exchange,
Yeah,
right? If you
there's like
just look at the
$42
ETF.
billion in daily volume right now.
Yeah, exactly, right? Like, so, we're spitting in the ocean even if we sold everything every day.
Right, right.
So I think it's important to have a contextual scale on that point. The second is, I think, I'll tell you what we say at GRIID, which is just always be having, right? Because you can have a bunch of different ways. Network difficulty can double, price can get cut in half. So there's a bunch of different energy prices could double. So there's lots of different ways that you can achieve like halving style economics that hit your business, and those can come at any time. And so you always need to be prepared for the next halving the day the previous one happens. I think what we saw is that this halving was probably a lot more orderly than the ones previously. Part of that is, I think, the network is buying lower cost electricity this time than previously. I think because mining revenue was so abundant in certainly in like 2021, I think people signed less effective power agreements. I think people are more disciplined this time. I think machine efficiency and refresh cycles were handled more proactively. I think, and the reason I say this is just because we saw network hash rate drop off more slowly in the month after this halving than in the month in 2020.
Yeah, absolutely.
There was also a lot of sort of macro disruption with the China ban and other stuff last time around. So I think the whole industry was just way less mature then. But right now, I mean, the industries we're pushing, somewhere between 15 and 20 gigawatts of total demand across the entire network. It's just a lot bigger than we were last time. It's probably up 5 or 6x since the last halving.
Yeah. Yeah. No, you're right. We didn't see that like crash in hash rate like the last halving. It was more like orderly. And then it
Yeah, we
wasn't,
came
I
down,
think it was,
whatever, 10 or 15%,
yeah, it was
maybe.
like 10 or, yeah, something around there. Yeah. So I think you're
So
right. I mean, it checks out.
I
Checks
just
out for
think we were
sure.
more prepared. It's a more mature sector
Yeah. Yeah.
than it was in 2020.
Yeah. It makes a lot of sense. Well, great, Harry. I mean, I'm kind of out of questions. This was fantastic, man. We got to get you back on here. Before we let you go, like, would you mind telling the listeners just where they can find you and all that jazz, and maybe if you want to send them over to Bitcoin Park or whatever you want to do.
Yeah. So Twitter is the easiest place to find me for sure. Just Harry_Sudock. And then bitcoinpark.com/meetup. Check out our meetups and come to one. They're fun. We're friendly. And then GRIID is just ticker GRDI on NASDAQ, and grid.com with 2 I's. Would love to see you in any of those places, and find me on the internet or at a conference near you.
Absolutely, yeah. And congratulations again to you and the GRIID team.
Thank you.
It's always a good thing when there's public Bitcoin companies, I'd say. So awesome job. And I'll see you in Nashville. So I'll definitely make it over to Bitcoin Park and we'll grab a beer or something. So thanks for coming on the show. I appreciate it.
Absolutely. Thanks, Sam.
All right. Well, everybody, I hope you enjoyed that. I really did. I feel like he always has very logical answers and insights. And so we got to get him back on. Like I said, go check him out. Go check him out on X. Go check out GRIID. Go check out Bitcoin Park. Like I said, I've been there. It's a great place. There's something special in the air in Bitcoin Park. And so I can't wait to get there next month. But I have to bring up Pacific Bitcoin. That's the event we put on in beautiful Santa Monica. Is October 18th and 19th. You can use the promo code SIGNAL to get 10% off, and then Bitcoin to get an additional 21% off. So go check it out at pacificbitcoin.com. We got great speakers, workshops, side events. It's fun to shake hands with other Bitcoiners and just have in real life conversations. And so I recommend it. I'll be there. It's one of my favorite conferences of the year. And I hope you enjoyed the show. Just let me know what you think. Like it, comment, subscribe to our YouTube channel, please. It just helps us get the Bitcoin message out to a wider audience. And then remember, 10K right now, no fees at Swan. So now's the time to stack some sats with no fees. And just appreciate you guys tuning in. We got another excellent episode lined up next week with another very intelligent guest. I think you guys are going to really enjoy it. And with that, I will see you then. Thank you.